Okay, let's begin. Thank you everyone for joining another Accolade blockchain webinar. We're excited today to be hosting Ben Forman. He's the founder and managing partner at ParaFi. We have an important topic to discuss today with Ben. It's stable coins and the tokenization of real world assets on the blockchain. Before we jump straight in, if anyone has questions, please enter them at the Q&A box at the bottom of the screen. We will try to address all these questions during the webinar. Ben, thank you for joining.
Yeah, thanks a lot for having me. It's a pleasure to be here.
So Ben, maybe you can give us an intro, some background on yourself, first of all, and then also on ParaFi.
Yeah, absolutely. So I founded ParaFi in 2018. We're an investment and technology firm that is focused exclusively on the blockchain and digital asset ecosystem. ParaFi is a bit different from many other funds in the space in that we're not just a venture fund, we're not just a liquid token fund. We have strategies that really span the full gamut of activities and investable universe in the blockchain space, from early to growth, from illiquid to liquid, from companies to tokens. So that gives us really a very broad perspective into really everything that's been happening in the ecosystem. My background personally is 10 years in traditional finance. The majority of that was spent really in credit and private equity investing. So prior to launching ParaFi in 2018, I was with KKR. I was a director in their credit business. I spent a lot of time on distressed restructurings, private credit, structured credit, and then prior to that worked at TPG. Prior to that worked at another private equity firm. And so that kind of grew up getting trained in traditional assets. In 2015, I came across Bitcoin. And then in 2016, stumbled across smart contracts, like shortly after Ethereum launched. And the ability to use smart contracts to execute financial logic, it was really fascinating to me. And for me personally, was really my 0 to 1 moment. There was a project called MakerDAO in the early days of Ethereum, which still exists today, which basically took a credit agreement and distilled it into code, basically distilled that legalese into if-then statements. And for me, I found that just fascinating, having been familiar with the supply chain of debt capital markets and how complex and inefficient it was. So I ended up leading blockchain research at KKR for a couple of years, and then before eventually, really wanting to go out on my own and build a firm kind of completely dedicated to blockchain and digital assets. So we're now here 7 years on through our, into our journey, and it's been like a really exciting time, particularly the recent months as the regulatory environment in the US kind of unfreezes. So I'm sure we'll cover that as we talk about stable coins and real world assets. But that's a bit about my background.
Oh, that's great, Ben. So let maybe start stable coins. Stable coins are really the first tokenized real world asset, also the largest market in this space. And it's been growing dramatically over the past few years to the point where, we were looking at some stats and it's rivaling Visa in terms of the volume of transactions in 2024. So perhaps, can we start with a history of stablecoins? So what are they? How did they come into existence?
Yeah, definitely. And I would just say, like, kind of, we'll talk about the history. I think just on a very high level, you can kind of disregard many things in crypto and say, hey, they don't have product market fit or they're speculation. But stable coins, if the only thing that came out of blockchain technology was just stable coins, I think it would be just a multi-trillion-dollar kind of innovation in my view. So if you look at what's happening on blockchains today, about 70 to 80% of all settlement on public blockchains relates to stablecoins. So if you think about stablecoins today are about a $200 billion market. Liquid crypto is about $3.5 trillion. So stablecoins are about 6 to 7% of aggregate crypto market. But again, they're 70 to 80% of every settled transaction on a public blockchain. So really, if you ask yourself what's happening on public blockchains, people are moving dollars. So stablecoins are really just dollars. The essence of a stablecoin is you're putting a dollar into the file format of a token. And by doing that, we can talk about what advantages that has, but you can basically move it 24/7, 365 for much lower cost than using traditional payment rails. And you can do it in a way where you can directly custody that asset yourself. And there's a number of other advantages. But your question was like, what has been the history of stablecoins? How did they develop? And I think that's a great question. If you go back about 10 years ago, so call it 2013, 2014, there were a few of the early crypto exchanges. One of them was called Bitfinex. Many of these early crypto exchanges really struggled to get banking relationships, and they struggled to build integrations into the traditional banking system. In part, that was due to regulatory concerns. In part, that was just due to the inefficiencies of going from fiat to crypto. And as a result, a team out of Bitfinex created a digital asset called Tether, which today USDT, which is currently the largest stablecoin in the world. It has about $135 billion outstanding. And the idea behind Tether was that traders on Bitfinex could, basically interact with the platform without having to wire in fiat and connect their bank account. So they could send in Bitcoin to the exchange. And if they wanted to convert into a stable currency, they could convert from Bitcoin into Tether and, then go back from Tether into Bitcoin or Ethereum or other assets. So Tether like slowly but surely started to take off because it was just useful in that respect. And other exchanges popped up without banking rails altogether. So, you didn't connect your bank account. You just sent in Tether, started trading with your Tether, and, you could run an exchange without any banking relationship. And actually, fascinating enough, Binance, the largest crypto exchange in the world, fastest business in history, I believe, to 1 billion of EBITDA in any industry, didn't have a single bank account like 5 or 6 years into its post founding. It solely was reliant upon stablecoins to deposit money. So that's how Tether initially took off. But then once people realized, once you had Tether, what you started to find is people just started to use Tether, not just for trading on crypto exchanges, but also peer-to-peer. And we can talk about what we're seeing in emerging markets, in a bit. I'm sure we'll cover that. But what people found useful was stablecoins effectively facilitated a global Venmo or a global PayPal where people could send money to one another outside of the purview of any sort of bank, outside of the purview of any institution. And, I always like to go back and study history. And I think like one of the best ways to understand the stablecoin market is to look at the Eurodollar market. And Eurodollars are effectively kind of a dollar-denominated deposit held outside of the US. And they're not just held in Europe, they can be held in Asia, it can be held in the Caribbean. It's basically, if a Japanese bank, as an example, deposits $1 into a bank in London, that's referred to as a Eurodollar. And this is a market that took off post-World War II because if you held dollars in a US bank, that bank had interest rate caps, it had reserve requirements, and you were also subject to regulation of the US government. So post-World War II, this idea of a Eurodollar market just kind of completely took off. And today, the Eurodollar market is bigger than all US banking deposits. And the Eurodollar is used, ubiquitously in trade finance. in international settlement. They're used by multinationals. During the Cold War, Russia deposited dollars in, with European banks because they didn't want to be subject to US banking regulation. So the reason I mention this is, one framework for thinking about what a stable coin is, in effect, it's a euro dollar. It's a token that allows someone to hold exposure to dollars outside of the context of the US banking system. And that is that is a powerful kind of concept. So, this market, that's a little bit about the history. I mean, this market is growing incredibly quickly.
Let me ask you a question here, Ben, because you mentioned PayPal and Venmo, and I get this question very often from folks. If I explain stable coins and the benefits of stable coins, they say, yeah, but we have Venmo, we have PayPal. Why do we need stable coins? I send money, via Venmo or via PayPal. It's instant, it's immediate. Like, why do I need stable coins?
Yeah, domestically, the domestic experience of sending like a Venmo from person A to person B is arguably better. The experience of using Venmo domestically, consumer to consumer, is arguably better than using stable coins. Where stable coins really shine as a medium of exchange is in cross-border remittance, is in B2B transactions, it's in hours outside of the banking hours. And it's in situations where you don't want to take counterparty risk of Venmo and PayPal. So each one of those points has a whole thread of different things we can talk about. One example is the average remittance, international remittance, goes through 2.6 correspondent banks, costs about $40 of wire fees, and takes about 5 to 6 business days to settle. So if you want to use Venmo, to send money to someone internationally, it's not possible. It's also it's not really a product that's suitable for like Pepsi or like a large multinational company, because you don't want to kind of take counterparty risk or face, a company like that. And also there are, restrictions in terms of the time of day that you can like send payments. So, banks are open 32 and a half hours a week out of the 168 hours in a week. What's amazing about stable coins is they're open and on 24/7. They're global. They're also permissionless to use and send. So Venmo and PayPal can deplatform you and not allow you to use their platform or product. It's not, which happens actually all the time. Whereas Ethereum is a permissionless blockchain where anyone can kind of use and access it 24/7. So those are some of the reasons why it's just like simply incomparable to those products. And just as, yeah.
So maybe to summarize, the way I understood it is, it's kind of like having Venmo and PayPal globally, but without the counterparty risk, and also without the deplatforming risk, and some more other attributes, but kind of the core essence of it.
That's exactly right. As a medium of exchange, I think there are, maybe we'll talk about this later, but the programmability of stable coins compared to the clunkiness of banking APIs is it also unlocks a whole new set of different use cases. So we're seeing AI agents use blockchain rails to conduct commercial transactions as opposed to using Swift or credit cards, because an AI agent can't necessarily open up a bank account. So there's a whole other, if you're looking at the primitive of simply sending money from point A to point B, yes, absolutely. And then there's a bunch of other kind of deeper kind of more nuanced reasons why stablecoins are quite useful.
Great. No, that's very helpful. Now, you mentioned emerging markets, and I had a question for you here. A lot of the stablecoin volume, and especially in the early days, related to intra-crypto transactions, right? Obviously, the Bitfinex traders, they were exchanging stable coins to Bitcoin and Ether and other crypto assets. How much of the activity in stablecoin volume has evolved to use cases that are real world use cases, if you will, outside the crypto ecosystem?
Yeah, I think quite meaningfully. So a couple data points. So, MasterCard came out recently and said that 51% of people in Latin America have paid for a transaction using digital currency. And then actually some of that's, just within fintech apps, but a subset of that, basically a third, were stablecoins. Bitso, which is a company, which is an exchange in Mexico, now facilitates 4% of all US to Mexico remittances, and it's all powered via stablecoins. You're seeing companies like, fintech companies use stablecoins to streamline the user experience in terms of on-ramping and off-ramping into their product. You've even seen Visa and MasterCard use USDC to expedite the working capital settlement process for merchants to get paid. So what you're seeing, the way we kind of think about it now is you're kind of seeing stablecoins really find their way into kind of consumer payments, into B2B payments, into trade finance. Actually, at ParaFi, we use stablecoins to pay invoices often, and we use them to pay to settle deals with teams that are overseas, as opposed to trying to wire them money. So we're seeing just a proliferation of different use cases, and a great kind of credentialization of stablecoins was recently Stripe, which is one of the largest private companies globally. A fintech player acquired Bridge, which was a stablecoin API company. And what Bridge had a few interesting customers that I think are really relevant to talk about. So one customer is SpaceX. SpaceX has employees in 100+ countries globally. And so paying an employee in Bangladesh or Bhutan or a country like it can be very cumbersome. And so they used Bridge to pay those, to pay their employees using stablecoins because it was much more efficient. Another example is the US government getting dollars to Ukraine in aid used Bridge's API. So what Bridge did functionally was allowed people to convert digital dollars into dollars in fiat in a bank account, and that on and off ramp really elegantly without ever touching stable coins or understanding how a blockchain works. And again, this kind of comes back to, I think the majority of us will all be using stable coins without maybe even knowing that we're using stable coins, or without even using the word stable coins. We're just going to think about them as dollars and feel like we're using dollars. And I think a lot of it will be abstracted away from us. So there are all those use cases. And then the last one I'll mention, because I think it's very relevant, is in emerging markets, you're seeing, particularly in Latin America, we're seeing a lot of stablecoin adoption. And in those markets, I think there's just demand to hold dollars. And it can be very difficult to have a bank account locally in those countries and have access to the dollar. Maybe you have access to the Argentinian peso or the bolivar or whatever local currency there is, but it can be very difficult to hold dollars. And you may want to hold those dollars outside of a bank, context of a bank. And so we're seeing just very, very meaningful adoption there. You're seeing it in Africa as well. If you actually look at, there's a bunch of interesting on-chain data that that shows that stablecoins tend to trade at slight premiums in emerging markets. They tend to move on chain in emerging markets more frequently as well. So the emerging markets are really just the core, one of the core markets for stablecoins as a product, as opposed to people sitting in the US where there's maybe less of a need for them.
Oh, that's great. Very helpful. Let me ask you a question. Stablecoins have been around for many, many years, right? And yet we saw Stripe just acquire, as you mentioned, Bridge, its largest acquisition ever. Why are they doing this now? What did they see now? Like they're plugged into this space. They know this space, but yet they decided to do it now versus like 2-3 years ago.
Yeah, I think it's a great question. So I think it's getting to a scale. Stablecoins are getting to a scale where there's just simply like difficult to ignore. So there's now close to 200 billion of stablecoins on chain. Just in the last month, there were $3 trillion of stablecoins that settled on chain. If you adjust out kind of certain volume that's inorganic, it's roughly $700 billion last month that settled on chain. So that's 8.4 trillion annualized. And just as context, PayPal settles roughly $500 billion a year in stablecoin. So this has gotten to the point where it's close to 20x PayPal's volume. It's roughly double Visa settlement volume. It's roughly half of all ACH. It's a few percent penetration against FedWire. So it's getting to a scale where like it's simply very, very, very difficult to ignore. And the numbers all have been marching up in either bull or bear markets. Like stablecoin active addresses sending and receiving, stablecoins outstanding, all these things are just up and to the right. They're currently 120 million wallets that hold stablecoins, roughly 35 million addresses that sent stablecoins in the past month. I mean, these are very, very large numbers. And so I think what Patrick Collison said was he equated that stablecoins were equivalent to room temperature semiconductors in terms of just the breakthrough of how easy and streamlined it is to send dollars on the internet. Why did they just wake up to this? I mean, it's a great question. They were, they were dabbling in crypto in the prior bull market and then shut down their operations. And now they're back and they've said, look, they've been monitoring the space over that time frame. I think, I was listening to a fintech podcast the other day, so not a crypto podcast, just a fintech podcast. And at the end, it was with the president of Stripe. And at the end of the podcast, he was asked, hey, what's your most contrarian view, like on the world, on anything in fintech and finance? And he said, my most contrarian view is that stable coins are a very useful technology. And like, as someone in crypto, that's not really a contrarian view. It's like actually very obvious. It's like the most probably least controversial, thesis you can have in crypto is that stablecoins are useful. But I think the incumbents in the financial world are like slowly waking up to this, and it just takes time. And you realize like stablecoins are not consensus yet. They're still contrarian. Most people don't know how they work or how they operate. And so it's not a great answer to your question, but I just think it's taken time for them to get comfortable that this technology is going to mature. I think more regulatory clarity helps. I think better infrastructure helps. I think layer twos that reduce gas costs, settlement speeds also have helped. So the infrastructure parts helped, but I think this was inevitable. This has been inevitable for a long time.
I was going to mention the infrastructure improvements, and it used to be much more expensive. Just go through Ethereum. Probably cheaper than doing an international wire if you did send money abroad, even on Ethereum gas fees. But now you have Base, you have all these layer twos, you have Solana, and the cost of doing that is just minuscule at this point. So I'm sure people will take notice.
Yeah, I mean, someone the other day, we were looking on chain, sent like $1.2 billion on Arbitrum, and it settled in like 1 second, and it costs like 80 cents so it's when else have you been able to send like billions of dollars with 1 second settlement times and cost less than $1? So yeah, I think I think the technology has gotten a lot better, and if you go back in time, it just wasn't practical, particularly for very small transaction quantities as well, because the gas costs don't scale linearly relative to the amount sent. So it really wasn't practical to send $80 or $200. because the fees on a percentage basis were too high. Maybe for the larger transaction amount, it did make sense. Now, however, it makes sense for both small and big.
Absolutely. Now, what are the investment opportunities in stable coins? So if you had to map out the stablecoin ecosystem, there are many players and subsectors within stablecoins. Can you describe them a little bit, and also kind of where are the investment opportunities? How will people make money investing in the stablecoin sector?
Yeah. So we actually spend a lot of time debating the best way to play this theme, like the growth of stablecoins, as we think about investing across the landscape. And I think that every company and every protocol in crypto is a stablecoin company and a stablecoin protocol, because stablecoins are what's being used across everything. So if you're investing in a wallet, like you're kind of making a bet on growth in stablecoins. If you're investing in an L1 like Ethereum and Solana, I mean, it's like 70 to 80% of all settlement on those blockchains is stablecoin based. Same with L2s. If you're investing in an exchange, if you're investing in really anything in the space, you're kind of long this theme of stablecoins, which is a great secular theme to be long because it's non-speculative. So that's like kind of the first way to, I think, approach my mental framework for answering your question. But to get like maybe like a little bit more granular, I think like specifically focused on stablecoins, there are a few different categories. So the first and maybe the most obvious one are the issuers of the stablecoins themselves. So Tether has, through the first 9 months of this year, made $7.7 billion of profit. They're the 18th largest holder of US treasuries. So they hold more US treasuries than like, Germany and Australia. And this is an incredibly profitable business. The longevity of that profit stream, the terminal value with rates coming down and maybe, more yield-bearing stablecoins on chain, we can have a debate around it. But, Tether and Circle also, which is likely going to be a name that goes public in this cycle, are both incredibly profitable in this environment. You have PayPal that's issued a stablecoin. You have fintechs like Revolut that have issued stablecoins. And then you also have some on-chain networks like MakerDAO, Athena, Frax that have issued stablecoins as well. So that issuer segment of the market is very interesting. And the fundamental business model there is you're issuing stablecoins, which pay zero. You're holding kind of the deposits that make short-term rates. So you kind of capture that spread. And that has been very profitable in this past cycle. So that's kind of like the first and most obvious. Then the second category I would say is more like infrastructure businesses within the stablecoin space. So we kind of touched on Bridge, which has stablecoin APIs, which makes it very easy to go from fiat to crypto and back again. That's really just a SaaS business. You have businesses like Paxos that are make it easy for companies to launch their own stablecoins. So there's like a whole set of different infrastructure businesses. Then there are companies like the fintechs themselves that already have customer bases, already have applications, already offering different financial services, but are using stablecoins as a way to streamline their backends, offer their customers the ability to kind of send, receive money more seamlessly. And we're seeing, we've seen some traditional fintech neobanks incorporate stablecoins, but we're also seeing a whole new crop of fintech companies that are built on stablecoins from day one that are growing quickly and with attractive unit economics. And then, look, I think like everything in DeFi, all of the infrastructure on the DeFi complex, the real world asset tokenization complex, many of these are all really derivative bets on the growth in stablecoins. So stablecoins are part of really everything in the space. And there are different ways to kind of play the theme.
Yes, but if I can take one thing from everything you said is that just by being in the space, you're taking a bet on stable coins and you're going to accrue some value from that secular trend just by being in the space, just by owning Ethereum, just by owning layer 2 tokens, just by owning a wallet. So that's kind of the key thing I took from your comments. And of course, there are plenty of other ways and business models.
That's exactly right. And if you look at just as like a simple fact that kind of reinforces that, if you own Ethereum, if you own ETH, the asset, and you look at one of the kind of the largest sources of ETH burn, which is kind of cash flow to ETH holders, Tether transfers and USDC transfers are, two of the top 6 sources of ETH burn. So it accrues directly to the layer 1. But you're absolutely right that it's, if you're in the space, invested in the space, by default, you're invested in the growth of stablecoins.
Great. Before we jump into real world assets, which is a broader topic, more nascent than kind of the stable coins and the tokenization that happened there, let's talk regulation. There was talk about a stablecoin bill in the US last year. It didn't happen yet. What needs to happen for stablecoins to take off? Like, do you think regulation is absolutely necessary?
I do. And I think under this prior administration, banks couldn't hold stablecoins because they had to reserve 1-to-1 against those stablecoins was one reason. So they couldn't then, run their kind of typical banking business model of like rehypothecating. So the reserve requirements were onerous, and also there were custody issues because these are digital assets and banks don't know like exactly how to hold them because you need qualified custodians. And so basically banks were boxed out of that market, and even asset management firms were kind of boxed out of that market. There have been a number of different stablecoin bills that have been proposed in the US that largely have not were not making progress under the prior administration. And this was during a time frame where Hong Kong, Europe, Singapore, other jurisdictions, like basically incorporated stablecoins into their digital asset regulatory framework. Of course, like a month ago exactly, with the new administration getting elected, with, David Sachs as crypto czar, with kind of complete like recognition that digital assets and AI are 2 critical technologies for the US to win and capitalize on. I mean, everything has changed. And it's very clear, like we're going to get a lot more clarity in the US from the SEC, also around stablecoin usage in particular. And the last thing I'll say is, look, like, I mean, stablecoins, I mean, the US's biggest asset, arguably, is the fact that the US dollar is the global reserve currency. It's used in 90% of international commerce transactions. If we are the reserve currency of the kind of traditional world, why wouldn't we also want to be the reserve currency of the digital world? You would think we'd want to dominate internet money, right? It's very good for our country for the dollar to win the internet in the same way that it's won the banking system. So it's almost like it shouldn't be a partisan issue. I think it's like very obvious and bipartisan that we would want that as a country. And I think it's now going to happen. Especially with Paul Atkins as the SEC head in this next cycle. I mean, he's made statements. He's very aligned around the growth of stablecoins. So I'm quite optimistic.
Great. We won't hold you accountable to this, in the future. But what do you think the stablecoin market will look like in 5 years? How big will it be?
Yeah, so we just came out with ParaFi came out with 10 predictions for the year 2030. And as part of that, one of our predictions was that stable coins would grow to 10% of US M2. US M2 is roughly kind of 20 trillion. So that would put stable coins at a $2 trillion market cap, which is 10x growth from where it is today. Candidly, if it only grew that much, I would be a bit disappointed. It's grown at a much faster CAGR over the past 5 years. So stablecoins have grown at about 120% compounded annual growth rate over the past 5 years, and getting to 2 trillion implies like a 50% go forward growth rate. So I think it's very, very conservative. It's also even more conservative when you take into account that stablecoins have grown in a high interest rate environment. So people are choosing to hold dollars at zero on chain when they could earn 5% in the traditional world. But look, I think we could be in a world where I believe we will be in a world where there are trillions of dollars of stablecoins on chain, and maybe the total value of stablecoins exceeds the value of digital assets that are volatile. I don't think that's an unreasonable place for us to go as an industry, especially if we add in tokenized, real world assets as well.
You've been mentioning interest quite a bit, and also these business models where reserves are held in treasuries, etc., and the issuers make a lot of money on the interest. What about yield-bearing stable coins? Is that the future?
Yeah. Well, I think that there will still be 0% interest rate stablecoins on chain, but tokenized treasuries and tokenized yield-bearing stablecoins are going to grow arguably faster on a percentage basis than stablecoins. You already have had BUIDL, which is BlackRock's tokenized treasury product, launched this year. That's now the largest offer, like kind of yield-bearing kind of stablecoin offering in the market. They have around 600 million under management, and that's the way it's structured. It's going to change, but it's effectively a 3C7 fund. So it's only offered to qualified purchasers. It's KYC'd. You don't get the same kind of functionality as you would with a simple stablecoin for regulatory reasons. And again, I think that's going to change. But you're seeing, Superstate, which is a portfolio company of ours, a variety of other kind of more yield-bearing options come to market. And I think that side of the market's going to grow very quickly.
So this is a great segue then to real-world assets and the tokenization of a broader range of assets than just US dollars and euros, etc. Can you walk us through the history again a bit? How did they evolve, and where are we now in their growth? And what types of assets are there on chain and growing?
Yeah, well, I think that many builders in the space, having found inspiration in the growth of stablecoins, ask themselves, well, what other assets can we tokenize besides dollars? It's clear what the advantages of tokenizing dollars are. The efficiency of sending them, the ability to hold them directly yourself, the kind of global 24/7 nature of them. Let's take those same advantages and apply them to, the other types of assets globally. So currencies, commodities, stocks, bonds, the long tail of different collectibles. Right now, today, there's roughly 15 billion of other tokenized assets on chain that exclude stablecoins. So that's about 7.5%, 8% of the stablecoin market. Most of the growth there has been in what I would kind of call fixed income-like securities, so private credit, bond-like instruments that have been tokenized. But I think this market arguably is going to get larger than stablecoins. There are a number of different really fascinating areas we're seeing. And I think it's kind of useful just to take a step back and say, why would you want to tokenize a stock, or why would you want to tokenize a bond? What actual advantage are you generating from doing that? And I think at the end of the day, this is formatting, right? And formatting matters. So a great analogy is bulk shipping. So in the 1950s, we moved from just throwing goods and services or goods onto big ocean freighters and sending them across from the US to China or vice versa. Now we have these 20-foot containers that are standard in the industry, and they're all the same size. And that's cut down on loading and unloading times. It made it very easy to get something from ship to a truck. You could build the chassis of these trucks catered towards those shipping containers. You reduced kind of theft and loss. And now those shipping containers are 90% of global intermodal trade and have made the global supply chain much more efficient. So we're still, shipping toys or clothes from the China to the US, but we're doing it in a much more efficient manner that's increased GDP. And so in the same way that we, put those goods in the file format of a container, we're putting assets that now live on spreadsheets or now live on DTCC or in databases, we're putting those in the file format of a token. And that allows it to kind of move more quickly, move at lower costs, move 24/7. You can possess the asset directly. And there are a number of different kind of advantages to each one of those that we can go into. This is an issue that's actually very near and dear to my heart, because having worked in credit and it would take us like 20 to 30 days for our back office to settle a distressed loan trade, because you'd have to look at accrued interest, and you had two different operations departments, and there would be payment waterfalls, and you'd have to like go back and forth on fund settlement. Did you get the wire? Here's our FedRef number. FedRef number it's incredibly inefficient. And we all know this, probably a lot of people on this call work in the financial services space. I mean, the only two departments that have grown at banks in the last 20 years are compliance and back office operations. So also the cost of settling trades has compounded we were looking at this the other day, it's like an 8% CAGR for the past 10 years. So the financial system just really is not efficient in the same way that maybe many of us would expect it to be. And tokenization is just this massive efficiency unlock, and then has all these other use cases that it really unlocks as well.
Why so much resistance to it? I guess there are people who are coming around, and most notably Larry Fink. He talks a lot about it. He thinks, if you see some of his interviews, he thinks it's really the next big thing in finance. He mentioned, I was watching an interview of his, he was mentioning how ETFs was a moment in finance that was groundbreaking. And in his mind, tokenization is one of these next moments in finance. Why, though, has there been so much resistance around it, or lack of understanding of the very clear benefits?
Yeah, I think there was more lack of understanding than resistance, because tokenization, when you explain it to anyone who works most people you explain it to in financial services, they get it very quickly. Whereas like if you explain to them Bitcoin, it's this new type of money, it like is volatile. It was created by this guy or gal called Satoshi. It's like, it takes longer to get up that learning curve. But if you just say, hey, blockchains are really good at asset settlement, and those assets can be, ETH or Bitcoin, but they can also be a stock, a bond, a currency, a commodity, a private credit instrument, an LP interest in a fund, whatever it is. Blockchains are like time-stamped Excel spreadsheets that anyone can view and no one can tamper with. It's not as, I haven't, at least, and I spent a lot of time just talking to people in traditional finance about this technology. Like there's much less resistance to it. And so I think similar to Stripe, and their kind of interest in stablecoins, I think it's just taken time. I know that BlackRock, we're co-investors with them in Securitize, which is one of the largest tokenization companies, is incredibly excited about this technology. And, Larry Fink, one of the things he said is, there have been like really two big technology leaps in capital markets. One has been the move from analog to digital. So in like the 1970s and 80s, when our stock markets went from, analog into kind of electronic format. And the next big unlock on that same, of that same magnitude is moving to tokenization, where every token is effectively its own QSIP. Every investor has its own wallet, and you can kind of unlock a whole variety of different use cases. So over the past couple of years, we've been just seeing material growth in this category. A lot of it is outside of, like what you'd read about in the Wall Street Journal or Bloomberg, because it's, maybe it's like not as like interesting or doesn't make for as good of journalism. But, everyone from the California DMV that tokenized car titles on the Avalanche blockchain to, Franklin Templeton and KKR that are tokenizing, mutual funds or LP stakes in some of their private equity funds, to actually ParaFi, our venture fund too, we tokenized the sleeve of that through Securitize on the Avalanche blockchain, because we want to not just invest in this technology, but actually kind of eat our own cooking. So, I think it's really taken off, and I think it's only going to continue just because I think fundamentally it's much more useful. I don't think it's, I think there are challenges. So it's not only blue ocean. There are challenges because institutions are slow to move on chain. The infrastructure build out still needs some work. And there are other kind of more technical issues. But I think that, we're seeing actual like real KPI growth in these categories, which is exciting.
Great, great. Going back then to the question of what assets are on chain. You mentioned, obviously stable coins first, dollars, euros, etc. Treasuries, yield-bearing stable coins second, private credit. What else is going on chain? What are you seeing today?
Yeah, it's like pretty interesting because we're seeing some of these like longer tail esoteric assets get a lot of like on-chain traction. So we invested in a company that's tokenizing high-end collectible cards, so like baseball cards, Pokemon cards, things like that. It's a huge market. It's in the tens of billions of dollars in terms of like the size of these markets. We invested in a company that's tokenizing physical watches, holding them in a bank vault, and you can redeem them using the token, but also borrow against them on chain, trade them on chain. That company is called Kettle, and it has very, very meaningful traction. We're seeing companies, there's a company that's tokenizing YouTube royalty streams, companies that are obviously tokenizing, real estate or farmland or litigation finance claims or carbon credits. And what these all have in common are that they don't have established capital market infrastructure. So you can't call up Morgan Stanley and say, hey, I want to buy like a strip of high-end, Pokemon cards. But there is material demand to buy, sell, trade, borrow against these assets. And these assets, the physical collectible and virtual collectible markets are huge. They're very big. They're very fragmented, but very large. And so we're seeing many of these more niche asset classes almost like skip over traditional capital markets because they're too small for banks to support, and they're going immediately on chain. And they're starting to get to like levels of penetration where if you are involved in that particular asset class, you almost like need to be on chain. So it's almost demand pull. And that is exciting. So like we're seeing a lot of traction in that long tail. And then also in the like fat part of the tail. So, obviously stable coins, treasuries, and private credit. We've seen less in public equities. We've seen some LP stakes in funds, but it's really on like the most liquid stuff like treasuries, and then the most illiquid stuff like the longer tail of assets.
Similar to my question on stable coins, how big do you think this market can get and how soon?
So the global asset base is, if you just look at the big four asset categories, stocks, bonds, currencies, and commodities, is 600 trillion. We also, one of our predictions from our presentation was that we think that this market will dwarf the size of all digital assets, and that the most relevant metric for any blockchain will be how many real world assets do you have tokenized on your chain. I think that will be the most relevant metric for any, how many wallets are actually holding real world assets and how many total assets do you have on your blockchain? Because right now, if you look at like the average Ethereum wallet, maybe they hold some NFTs, maybe they hold some like, DeFi tokens or other infrastructure related tokens. But I think we're going to be in a world that's vastly different than that. And so, so I think this market will measure into the tens of trillions of dollars over time.
But you do, I assume, expect it to move slower than the stablecoin market, which has taken off and it's found product market fit at a grand scale at this point. Would you say so?
Yeah, definitely. Like, and if you look at like the way these markets scale, they kind of go on S curves because they're network effects technologies. So if you look at Tether, I believe like as of the ICO boom at the end of 2017, don't quote me on this exactly, but there was maybe like $1 billion of Tether or less than $1 billion of Tether during the ICO boom. But it's grown over 130x over the past 6-7 years, because it has to hit a critical mass for it to be useful. And it's these assets are like, it's like the telephone. If like you're the only person on earth that owns a telephone, it's not a very useful technology. If one other person owns it, well, it's kind of useful, but you can just call them. But if everyone has a telephone, well, then it's like where you really unlock the power of the technology. So it's very much a Metcalfe's law technology. So similar with these real world assets, right now, if you're like the only person on chain that holds tokenized carbon credit, no one else is on chain to buy it or lend against it or transfer it to, it's not as useful. So I think the way these things are going to scale is kind of gradually, then suddenly. Once you get to that critical mass, you start to kind of hit that inflection point. And you're starting to see that now in a couple of these categories, including treasuries. You've seen it already with stable coins. And you'll start to see it in more and more of these sub verticals within the real world asset space.
How about the legal infrastructure? I've heard many folks say the benefits are obvious. We now have the scaling technologies behind it, the layer 2s, the Solanas, etc., to actually make these things happen. All it requires is for traditional finance to join. And of course, it's not as simple as it sounds, but I'm saying, to make the leap to join. And then also for legal frameworks to adapt to these new containers, as you mentioned, because the legal frameworks are still reliant on, paper contracts and things like that. So what about the legal infrastructure and how easy will it be to evolve? It might be easier than the, TradFi moving into the space, or it needs to happen before. I don't know, but how do you think about that?
Yeah, I think it's a great question. I mean, I think that institutional trust and like kind of comes down to like, are these like are these instruments property, and am I protected in the same way? But if I hold a tokenized private credit instrument, do I have the same rights and remedies as a creditor as I would if I, memorialize that agreement via a PDF document that I sign? That's a legal agreement in, on a server somewhere. And in the UK, one of the interesting things they did was into their Uniform Commercial Code, they recognize digital assets as property. So they have all the same kind of common law rights that property, any form of property would have in the UK. So we don't have that same kind of broad sweeping kind of regulation that would give that type of protection. I do think that is a missing piece at the moment, at least in the US. Although I think that's kind of, again, starting to change. But the technology is ready. I mean, the technology is ready. I mean, blockchains are more scalable. You also have infrastructure now like Fireblocks, Coinbase, you have layer 2s. So if we were to go back 6, 7 years ago, I mean, most of the tokenization experiments that were launched in 2017, 2018 really didn't work because they were just too early because the infrastructure wasn't there. And the technology wasn't there because, these things were very expensive to send, receive, blockchains were slower. Those problems have really been solved. And now I think, as you point out, it's more of like, I view it as more of like a legal problem and just institutional education problem. But we're kind of ready to go from like a technology standpoint, which is exciting.
Yeah, and as you mentioned, it seems that the US is, who knows, but then in the next few years, it seems it's going to move towards a direction to make these improvements on the legal front and on the regulatory front that will allow, the move of traditional financial institutions into the space and kind of reaping the benefits of the space.
Right. And exactly. And by the way, like, people use the term institution as like this kind of monolithic term, but the reality is like one of the very interesting trends that we've seen is who are all the adopters of these tokenized assets? It's asset management firms. It's not banks. So banks kind of actually, asset tokenization and stablecoins are a big threat to banks. They're a threat to their margins. But the reason why BlackRock is interested in this technology, KKR is interested, is that their margin is our opportunity, as Bezos would say, is BlackRock pays a lot of money every year to Wall Street to have their securities settled, and this is a way to kind of and to fund administrators and transfer agents. This is a way for them to really internalize those costs and pass through those costs back to their consumers. So there's a big consumer surplus unlock, and also asset management firms, of course, like don't have the same degree of regulation that banks do. Banks are extremely regulated. Asset management firms just are a few notches down. And so therefore, like you've seen asset management firms just lean in much more heavily to this technology because it's very promising for them.
We're almost up on time, so I will ask you a final question, and it's related to layer ones. Which chains do you think are going to benefit the most from tokenization? And obviously, there's a lot happening on Ethereum and layer twos, but there's also a lot starting to happen and growing on Solana.
Yeah. So, it's a really interesting question. So if you look at let's just take Ethereum and Solana for a moment, and then we'll move on to other chains. But if you look at Ethereum and Solana and you compare just the total amount of real world assets outstanding, let's include stablecoins in that, it's not even close. Ethereum and its corresponding layer twos have many more billions of dollars of outstanding stablecoins than Solana does. Now, if you look at the total transfer volume of those stablecoins and real world assets on chain, so look at the flow, don't look at the stock. Solana actually looks a lot better on a relative basis versus Ethereum, although they're it's still lagging. So my general view is Ethereum right now, I think one of the most powerful narratives that Ethereum has going for it relative to Solana, and I think Solana's done incredible work catching up, and there's different thesis for each asset because they have traded different valuations, of course. But just to give Ethereum some credit, it dominates stablecoins. And it dominates kind of real world asset activity. So BlackRock issues its BUIDL product, its tokenized treasury product on Ethereum. Most RWA projects are on Ethereum. Most institutional activity on chain is on Ethereum. By the way, when I say Ethereum, I mean Ethereum and layer twos, kind of group them together. Solana has been more active and effective at kind of retail usage of stablecoins, and other things like DPIN and other kind of pockets of the market. But I think they're both going to do great things when it comes to bringing real world assets on chain. I mean, and we spend a lot of time talking to all like the layer 1 and layer 2 teams in the space around what's your real world asset strategy, what's your stablecoin strategy. And unless you have stablecoins ubiquitous and liquid on your blockchain, I mean, it's really tough for developers to want to build other applications. Because again, like if you're building an NFT marketplace, if you're building a gaming protocol, if there isn't stablecoin liquidity on your chain, you may struggle to really gain traction. So it's just absolutely essential. So I don't know if I kind of answered your question, but that's kind of how I look at it.
No, 100%. That was very, very helpful. Well, Ben, thank you very much for a very engaging discussion. And thank you everyone for attending today. And as always, if you have any questions, don't hesitate to reach out back to us with any questions. Thank you.
Thank you so much.